Is CVS a buy or a sell? Let's get started with the model. This is a large cap company, 62 billion market cap. They're trading at $49 a share, and they have 1.3 billion shares outstanding. CVS sells prescription drugs and a wide assortment of general merchandise. The company's headquarters are in Woonsocket, Rhode Island. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Look at this decline. It was nearly 16 billion in 2021. Now it's 1.7 billion. It goes down a lot each year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's gone down, but not nearly as bad, from 8 billion to 5 billion. This type of company has really slim margins, between 1 and 3%. Revenue is a sales for the company, and it doesn't get much higher than this, from 290 billion to 369 billion. In terms of revenue, they're in the top 0.1% of all companies. They do pay a hefty dividend, 5.4%, which is a reason people buy the stock, but they cannot afford the dividend. They can only cover half of it with their free cash flow. Either they need to cut their dividend or bring in more free cash flow, or take on debt to fund the dividend. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 123 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $100 billion. We divide that by 1.3 billion shares. And we get a calculated stock price of $79. They're trading at $49, so they're trading at a 38% discount. It's a buy according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 11 companies in the same industry as CVS, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the second most in CapEx, 2.9 billion. United Health Group spends the most, 3.5 billion. They have the second worst debt to equity ratio. For every dollar of equity, $1.10 of debt. They pay the biggest dividend by far. No one's even 2%. They generate 1.7 billion of free cash flow, third highest on this list. And they rank fourth in market cap at 62 billion. They're trading below book value. Their price to book is below 1, which means the equity on their balance sheet is higher than their market cap. A really attractive PE ratio, 12. Price to free cash flow is a little better than median at 37. And they have one of the better price to sales ratio, 0.2, which implies their revenue is 5x their market cap. They're not growing as much as the other companies though. Their 5-year annual revenue growth rate is 9%. And they're trading at their 52-week low. So it could be a good time to get into the stock. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd be all over the place. But currently you'd be at $7,000, down 30%. To summarize, I have them trading at a 38% discount, ranking 6 out of 10. I think it's a good short-term buy, because it seems really undervalued. Long term is a little questionable. Their ratios are pretty good, 6 out of 10. A good PE, a really good price of sales. Financials are not so great because their free cash flow is going down so much. Their revenue is going up a little bit, so I give them 3 out of 10. Let's take a look at their income statement. Here's a third quarter 23, third quarter 24. Revenue is 95 billion just for one quarter. Last year was 90 billion. Product revenue is down. It was 61 billion, now it's 60 billion. Premiums, insurance premiums, that's up a lot from 25 to 31 billion. Services is up a lot, 3.5 to 4.3, and net investment income doubled. Here's a different breakdown of the revenue. 33 billion healthcare benefits. Most of that is insurance premiums, 31 billion. 44 billion health services. Most of that is pharmacy, 41 billion. Pharmacy and consumer wellness, 27 billion pharmacy, 5 billion front of the store, when people buy things like gum and magazines. Let's look at this income statement. It gives percentages. So products is down 2.6%. Product revenue went down, but every other revenue went up. Premium went up 25%, services 21%, and net investment income 98%. So total revenue up 6%. Their product revenue is 60 billion. The cost of product revenue is 53 billion. Then you have healthcare costs, 30 billion, operating expenses 11 billion. So total expenses 95 billion. So there's not much left over, only 800 million left over after expenses. Last year was much higher, 3.7 billion of operating income. So that's down 78%. They have a lot of debt, so they spent 750 million of interest on their debt. Their net income is only 71 million, down 97% from last year. Last year was 2.3 billion. And they did decrease their shares outstanding. Last year, 1.28 billion, now it's 1.25 billion. EPS is down a lot. It was $1.76 last year, now it's only 7 cents. Let's look at the balance sheet. Current assets 67 billion, current liabilities 85 billion, so their current ratio is below 1. So they're going to have to add some debt to get through the next 12 months. Total assets $250 billion. Their biggest asset is goodwill. Goodwill is the premium you pay when you acquire another company. That's 91 billion. Their second biggest asset is accounts receivables, 36 billion. Then long-term investments, 29 billion. Intangibles, 28 billion. Total liabilities, 177 billion. Their biggest liability is long-term debt, 60 billion. Here's a breakdown of the long-term debt. It's a really long list. Here's the interest they pay and when it's due. So $750 million of senior notes at a 3.5% interest rate due last month. They have $5 billion due in 2028 at 4.3%. And you can see it's a long list. It keeps going. In 2048, $8 billion at 5.05%. And here's the end of the list. Long-term debt, $59.8 billion. Assets minus liabilities equals equity, 75 billion of equity. They raised 50 billion from selling stock. They bought back 37 billion of stock, and their retained earnings is 62 billion. That's how profitable the company is historically. Let's look at a statement of cash flows. Operating cash flow is down. It was 16 billion. Now it's only 7 billion. They use the less popular direct method. Most companies use the indirect method when doing the statement of cash flows. It gives you the same result, just a different way to lay it out. In their investing section, they had a cash outflow of 7 billion. They spent 2 billion on PP&E. In their financing section, they added 5 billion of debt. They paid down 1.7 billion of debt, bought back 3 billion of their own stock, and they paid 2.5 billion in dividends. Let's take a look at the company on Simply Wall Street. Its last price, $49, 62 billion market cap, down 11% in the past week. Even worse in the past year, down 34%. When is the bottom? When will it finally go up again? Here's the stock price since 1990. It was 11 bucks. 11 years later, it tripled to 30. Then it came all the way down to about 13. It rose past 40 for the first time in 2008. Then it came down into the 20s once again. It took until 2012 to get back to its previous high. And then it had a massive bull run up through 2015, over $100, its highest ever, hitting 113. Then it fell to the low 50s in 2020. It ran back up to 100 again in 2022. Now the stock is trading at $49. And that was the price 12 years ago. If it comes down to $40, which is not too far off, that will be 17 years ago. I'm assuming if it hits 40, it'll be 2025. And the last time it was at 40 was in 2008, 17 years before. Simply Wall Street is really bullish on this one. They're at 214. They say the stock is 77% undervalued. 214 is double the price of its all-time high. It seems a bit of a stretch. I can see maybe 100, but 214, that's going to take a long time, possibly a decade. 25 analysts priced this stock at 68. They also say it's undervalued. Here's their revenue since 2013. It was 127 billion. It almost tripled since that point. It's at 367 billion. Here's their debt since 2013. It was 13 billion. Its peak was 74 billion in 2019. It's currently at 64 billion. But their equity is a little higher than their debt. Equity is 75 billion, so it's not that bad. They have almost 10 billion of cash on their balance sheet, which is plenty to service the debt. If you assume they pay 5% interest on 64 billion, that's about 3 billion of interest. And their dividend yield has gone up so much because the stock price has gone down so much. It was only 1.4% in 2015, 3.7% in 2019. Now it's getting close to 5%. The forecast is 5.2% by 2026. And they are raising their dividend each year. It was 35 cents in 2015. Now it's up to 66 cents currently. That's just for the quarter. In the past year, there's been 2 insider buys, 1 sell. 83% of the companies owned by institutions, 17% by the general public. The biggest shareholder is Vanguard at 9%, Dodge & Cox at 5%, Morgan Stanley, Franklin Resources, T. Rowe Price, JP Morgan, and Columbia Management to bottom out the list. They employ a small army from 169,000 to 260,000. At one point, it was 295,000. And the ticker trades on the New York Stock Exchange, Deutsche Börse, Xetra, Mexican Bolsa, Santiago, the Bern, London Stock Exchange, Euro TLX, Wiener Börse, Lima Bolsa, the BATS Europe, Sao Paulo Bolsa, the NEO, and the Buenos Aires Stock Exchange. If you want a free discounted cash flow model, watch this video in the top right corner.